Yes, I wanted to mention that what you were talking about, the Federal Reserve, that wanted to change the barrel. There was no Treasury bill. What I read is that the idea was for when they have to go back to cutting, to not stress the balances of the primary dealers, they would simply stop. They would let the Treasury bills mature. Because now the QT problem is that stresses the balances, and that's when it creates problems. So, according to what Waller, the Fed, said, that was the goal. It is interesting because in addition, that would allow them to do, in case they want to make a following. QT reduce the balance much faster, because now the limit, so to speak, apart from the upper limit that they set. Let's say the problem is that you can't put in as much as you want because maybe you don't have enough assets at that rate. I understand the concept, but again, maybe I have to study it more. But it's hard for me to understand why the Federal Reserve would start to have an inventory of the short side of the curve. I find it very difficult to see. That is, no, it doesn't make sense from perspective of, well, touching the curve. Maybe it doesn't have to do with the yield curve at all, right? And maybe I'm focusing incorrectly, but not in that part. No, it's not very clear to me. My intuition, but I would also need to look into it more deeply to know exactly what it is that they want to do and how. Well, of course, before 2008. In the assets of the Federal Reserve, there were many Treasury bills, and they used them for open market operations. That is to say, the way to control interest rates of the market in quotes. It wasn't to establish like this is the interest rate. I mean, they were going. Let's see, the thing is, as the reserves are much scarcer, the type of interest rates varied more. So the way they had to counteract this was through open market operations. And so, when the interest rate rose above what they wanted, so they were doing the opposite to make it so. That is, injected more reserves with open market operations so that the interest rate would go down. When it dropped too much, well, they no longer did so many open market operations for the interest rate to return to the level that they considered, etc. So, it may have something to do with that, and with the idea of reducing the balance sheet. And having them there, well, I don't know if for some kind of repos, loans, or whatever it is. Yes, from the perspective of reducing their balance. Makes perfect sense because maybe to explain to the people listening that the Federal Reserve has long-term securities in the form of Treasury bonds, but it also has mortgage-backed securities that are mortgage-backed assets, and those are ultra long-term that they have on their balance sheet, and also those assets are interest payments and principal payments, right? Like anyone who has a mortgage here in this chat, And that takes a long time to really see a reduction in the principal. So everything the Federal Reserve bought demonically sparked securities you'll have to wait for. Literally. On the day it expires. Because also, one of the ways that could reduce them is if rates go down and people refinance. Your houses know, so you go to a bank across the competition, the one who gave you the mortgage, and you say, I have a mortgage at 3, I want one at 2. Now that rates have dropped, and that kills that asset the Federal Reserve has at that moment. But what we know is that rates have not gone down. Rather, the opposite has happened, and that makes it even more difficult to get out of the balance of diversity. Federal, so from a perspective of being able to have more maneuvers on the duration of their assets. I understand a pride that they are saying. But from the perspective of touching the curve, it seems to me that it is. I mean, with the Petson, that's enough to touch the short end of the curve in the design. Federal, but again, you can be looking at it wrong. Yes, in fact, they have had problems with the issue of MBS because they want to get rid of them from the balance sheet because it is something that has been going on since 2008, and that is still there. And the problem they've had is exactly because interest rates are very high. Aren't they just refinancing? They do not get cleaned and therefore do not come off balance. You know? And no, they don't want that at all. They're all ready. We agree. In fact, I don't know why they bought them. They kept buying them when the economy was doing well, but well, that's another topic. Are you going to say something? Yes, what you say makes sense too, because that would allow them to increase the bank to the Treasury shouldn't continue with the Treasury bills, because once the curve already de-invest, that stress increases between 3 months and 10 years. For example, are foreigners profitable buying U.S. debt? So can they afford to increase the debt? Will they have buyers? Isn't it like now that how is the curve right now? They have to absorb it. The primary dealers that collapse the balances get stressed. I think they would kill 2 birds with 1 stone. De-invest the curve and aside. That if they have to make sure you don't stress the balances either. Okay, good. It's bullish, and I maybe want to delve a little into that so that people understand when the curve is very flat, which is flat, that the short part of the curve yields very similar to that of 10 years, or if it is inverted. So that the short part of the curve yields more than the long part of the curve. They're strong buyers of long-term debt, such as commercial banks and hegemons. Don't count one, and I will tell you why. Because there is nothing sweeter for these 2 types of entities than to borrow in the short term too. Buy long-term assets and earn the carry. No, the difference between short-term liabilities and what you generate in return in the long term. When the curve is flat or inverted, it is punitive. To get into debt in the short part to buy an asset that will yield you less. So those 2 types of buyers come out of the equation. And those that remain are mostly the rest of the world that has had a trend. Well, mediocre. Was I coming from purchasing debt and pension funds or insurers that have to forcibly buy long-term bonds to match long-term liabilities? No, then a curve. Healthy de-investment would generate, as Bull says, more demand from the long-term Treasury bonds. Then with respect to the RRP, when it reaches 0, right now the TGA is already it's emptying in there. For now, liquidity is entering the banking sector. But of course, then starting in April, because tax time is coming, and then the debt ceiling, we already know that is a theater that, in the end, it's always approved in the end. We'll have to fill the TGA, and that's when there can be liquidity problems because they will have, on one hand, the tax payment that they have the reserve, and on the other hand, absorb the new debt that the Treasury issues. So that's when it is anticipated that QT might end in the 2nd or 3rd quarter. Ugh. Is that what the market is betting on right now? Yes, no. I said that in any case, the monetary funds have more than 7 trillion. I mean, there is liquidity. The thing is that the dealers can make a market. Absorb the debt. To absorb the cash from the money market funds. What is happening? For example, end of the quarter, end of the year, that there is liquidity, but the dealers don't accept cash? No, they do not mediate, letting due arbitrage for balance issues and passing it to users across currencies. So I'm blanking out. That I know that I had read, or I don't know who I read it to, or where, kind of like they might stop QT, or they paused it during the months of the debt ceiling issue, then to say, to continue with him as far as they considered. Or as if they could take a break in the most turbulent months, precisely to avoid stressing the market further. Draining liquidity with QT. Moreover, also the Treasury, etc. And then when that gets solved, we'll continue. But it doesn't have much continuation. I mean, more than a few months from my point of view. Yes, I agree. I believe that something that radically changes the liquidity of the system is if the extension is removed of the SLR to commercial banks. That, for me, changes the market. Could you explain a bit what the SLR is for those who haven't heard of it? But isn't there an exemption right now? No. But it is said that this is in the letters of the new administration. Let's see. The SLR is a Basel ratio. Leverage level in the banking sector. So then, as a bank, you can't have a leverage greater than what the SLR allows you. In fact, this was the consequence. Well, an exemption from the SLR would be for me to tell you, well, during this period of time, or indefinitely, or whatever, well, you no longer have to comply with it. You can leverage more than we allowed you until now. Then all this issue of the SLR exemption happened in 2020 with the COVID issue. The Federal Reserve granted a one-year exemption. This leverage ratio allowed commercial banks to leverage more. I intuit that so they could absorb or create all the necessary deposits. What did they need to get through this pandemic? And then in 2021, I think it was in April, was when it ended. I mean, they set it for 1 year, and when it was due to end, it ended. And then the commercial banks. Of course, they had a lot of deposits. And so many deposits couldn't be kept on balance because then they would be more leveraged with much more debt than the SLR allowed them. So the commercial banks told the money market funds, take the deposits elsewhere. Do whatever you want with that money, but here you can't have it. And then that's when, since they couldn't keep it in the bank, as there weren't enough bills, well, they put everything in the Federal Reserve's reverse repo. And then that's when it started to rise to the enormous levels we've seen now. A reverse repo. How curious how people have a... It is said in English, a reasoning goes, but it's... Do we only remember what happened in the closest past? Right? So people see the high RDP and think that is the norm, which is normal to have those levels, and when they aren't, an apocalypse comes. But that is too recent. As you explained well, I just wanted to mention that. That data, why? What rate? I have read a fatalism around the RRP, brutal. But they had it when it started to rise, and it exists when it continues, when it starts to go down. I mean, yes, it's true. To be fatalistic, it doesn't matter what is happening. It is always a good time, and maybe. To close. Me and Bull. What are you seeing these days that give you a bit of doubt or nervousness that could happen? Something in the markets? Is there something specific you would like to emphasize? For my part, I focus more on all the... which is more closely related to the central bank and bank reserves, etc. For the moment, things seem calm. I don't see those tensions I saw in February 2023. I will continue to watch this year to see what happens, especially regarding the topic of QT, the drainage of the reverse repo, and the debt ceiling. But well, right now I don't see any concern in that sense. I bring school. For this year, I also don't see any problem, the base of the software. With federal funds, the spread, discounts that right now there are. Does it limit liquidity due to the issue of the TG recharge plus taxes in April, but starting in June, it turns negative. So until the end of the year, especially at the end of the year, which indicates either that QT slows it down or that. But come on, they don't see liquidity problems. Do you realize any problems? At least for 2025 then? So maybe tying what they are. They both just said if they don't foresee problems. This is an excellent time to buy. This drop in assets is not supposed to be, right? No. No, I don't get involved there. That I don't know. I do not recommend investing, but that. Of course, if it is supposed that what the market discounts is that right now, there's a bit of what? What's happening right now is that the dealers cannot intermediate because there is liquidity. Money market funds have 7 trillion. Store, but of course, if they do not mediate, well, they slow down a bit. But it's due to regulatory issues of the balances. It's not for any other reason. And I want that too, before closing, to break another of the myths that I love. And I have also read countless times that the liquidity that leaves the RRP goes to the assets of risk. Those who are listening, please listen to me. That is false. The money that is in the RRP doesn't end up in stocks or in crypto. Those are funds that they have. Corporations that save money through working capital and are funds that individual people put it to invest there as savings. So instead of having it in a bank deposit, they have put it into money market funds. As John said, because they generated more. So neither a company nor a person is going to transfer their liquidity to go buy. Farcoin, no, I mean. That is not going to happen then. A drop in the RP is that people I see saying, the RP is being drained. It's no coincidence that it is driving up the prices of risk assets. No, that correlation is quite murky that they are trying to force. Then I also wanted to give that opinion of mine. Yes, well, another false myth is that the money that is in money market funds, which is money on the sidelines, that is false. That money is always nice if it is not. If they do not invest it in the reverse record, which is not the norm. They invest it in the repo market. They invest it in agencies. They invest it, that money is always moving. Let's go. In fact, they are the main cash lenders in the repo market, which is the base. But of course, they need the dealers to mediate if not. If not, they can't, because they in the tripartite do not. No, they do not lend directly to the hedge funds, for example. And then another thing that maybe you all extend, but that implements the SLR exception for treasury bonds. And then it leaves space in the balances to continue creating market. It's a trend of all that, which well no. It's not that one is one that is from the banks, let's say, because it already allows them. Buying bonds doesn't congest the balances. So now I don't know if they're discounting that for the QD or that they implement the SLR section for. The bonds, the steel ones rarely fail. Yes, that for me is the biggest tailwind there could be this year if it happens. Exemption of the SLR. But well, John Bull and those who are listening, it's late. So we also don't want to abuse your time. And nothing. I want to thank you all very much for attending this space, and to Joe for agreeing, and to Will as well to opine. For me, it is a pleasure to share with bright minds like yours, and thanks to those who they listened. And if you have doubts, put them in the chat, and we will try to respond to them. So I don't know what final words. John Bull. Nothing. I also want to thank you here for spending some time chatting with you from the rod of the barrel. As I say in nothing, I hope to share another day all the time. The same. Thank you very much for the invitation, and with either of the two. Well, we can talk about these topics again whenever you want. Is that great, okay? So it's recorded for you to watch it later, and thank you all very much. Thank you very much. Have a good weekend. Well, greetings. A greeting. See you later.